This video is about risks of investing and how a diversified portfolio can reduce risk. Hello, I'm Peter Martin with Trading 212, and in this Basics of Investing video, we're going to talk a bit more about the risks of investing in the stock market. We're going to look at how a diversified portfolio can help mitigate certain types of risk, and we're going to discuss in a bit more detail some of those specific types of risk. Now, when you invest in the stock market, you naturally face the risk that something might occur that causes a collapse in the market. If you think back just over 10 years ago to the financial crisis, we saw stock markets around the globe falling by large percentage amounts all at once. However, catastrophic events like the financial crisis are rare. More rare, for example, than a single company running into trouble. And therefore, investing in just a handful of companies or even a single company is more risky than holding a diversified portfolio. So let's look at some quick examples to further illustrate why. So here we have a list of 4 theoretical portfolios. You should be able to see that these are increasingly more diverse in this direction. These are just purely to communicate the concept. So let's look at portfolio 1. This is not diversified in any way. 100% of your capital is tied up in HSBC. So imagine that company runs into some kind of problem and its share price drops. Then it's going to affect 100% of your capital. So let's move on to look at portfolio 2. We've still got HSBC in this one, but now you find that your funds are spread across a number of shares. So we are much less likely to be affected if something happens to HSBC here. However, what do all of these have in common? Well, they're all banks with an exposure to the UK. So they all have some kind of correlation. So let's move on to portfolio 3. Once again, we've still got HSBC, which is in all our portfolios. But now instead of having banks, we've mixed things up a little bit and we've got companies representing different industries. So we've got a telecom company there, a biopharma, a fashion company, a house building represented, and mining. So it's reasonably diverse. Once again, though, there are commonalities between all of these, and that's the FTSE 100 companies. Yes, AstraZeneca and Antofagasta, for example, are big multinationals with a global reach, but we can still do better. So let's move on to portfolio 4. And this time, we've still got our FTSE 100 companies here, but we've added in now a bit of geographical diversity. We've got a US company here, which is in software, and then a German company involved in apparel, and French company in alcohol. Iberdrola is a Spanish utilities company, and Amcor is an Australian company involved in packaging. So quite a diverse little mix in the fourth one. Obviously, there's not that many companies in there. You'd want to add in a lot more companies to actually be properly diversified. But this just gives you an example of how it all works. So let's now discuss some other types of risk that a diversified portfolio can help to mitigate. The first of these is liquidity risk. If you consider blue chip shares, let's say, for example, Vodafone or Barclays Bank or Apple or Coca-Cola, these big popular companies tend to have lots of buyers and sellers that are interested in trading their shares. And it makes it easy to find a buyer if you're looking to sell shares, or to find a seller if you're looking to buy shares. At the other end of the spectrum, there are some publicly traded companies that are much smaller and have far fewer people interested in buying and selling their shares. And if you invest in these companies, it could be tricky when it comes time to sell to find a buyer. Furthermore, liquid companies can at times move irregularly in terms of their share price. The next risk I want to discuss is currency exchange risk. And this arises when you're investing in a company that's denominated in different currency to your base currency. Let's say that you live in the UK and that you hold sterling, and you're investing in a company that trades in the States and its shares are priced in dollars. You're therefore going to be exposed to fluctuations in the pound against the dollar exchange rate. And that can have an influence on how your investment performs beyond just the up and down of the share price. Finally, there is political or geographic risk. The political stability and financial strength of a nation can vary from country to country, and therefore this is worth paying attention to. Generally speaking, a company that is based in a developing country will carry more risk than a company that operates in a developed country. I hope you enjoyed this discussion of risk and how to use a diversified portfolio to reduce it. If you did, please hit the thumbs up button and give us a like. And why not share your thoughts with us in the comments section? We do read each one. There will be more investment videos coming in the future. If you click on the subscribe button and then select the alarm bell icon, you'll get a notification for every new video. And we do add fresh content to YouTube on a weekly basis. But that's all for now for me, Peter Martin, and Trading 212. Thanks for watching. Goodbye.